Ever wondered how businesses manage currency risks in international trade? Well, they use a risk management strategy known as hedging. In the complex world of trade finance, hedging is the go-to method for mitigating potential losses from adverse price movements in financial markets. A common use of hedging is to manage what's called currency risk or foreign exchange risk, which is the risk that comes from fluctuations in exchange rates between different currencies. Now let's dive deeper into how hedging works in trade finance. So how does hedging work in trade finance to mitigate currency risks? Let's start with identifying currency exposure. When businesses bet on international trade, they first need to figure out their currency exposure, the risk that exchange rate fluctuations could impact the value of their foreign transactions. It's like a sailor checking the weather before setting sail. Next comes the choice of hedging instruments. Just as a sailor has various navigational tools, businesses have a range of hedging instruments. Forward contracts, options, futures, and swaps. Let's understand these tools. Forward contracts are agreements between two parties to buy or sell an asset at a specified future date for a price that is agreed upon today. Options give the buyer the right, but not the obligation, to buy or sell an asset at a set price on or before a certain date. Futures contracts are standardized forward contracts that are traded on an exchange. They obligate the buyer to purchase an asset and the seller to sell an asset at a predetermined future date and price. Swaps are contracts in which two parties agree to exchange the cash flows or liabilities from two different financial instruments. These tools allow businesses to lock in exchange rates for future transactions, providing a level of certainty about the future value of their cash flows. It's like knowing the exact route before you set off on a journey. Then we move on to executing hedging contracts. Once a business knows its currency exposure and has chosen the right instrument, it enters into a hedging contract with a financial institution or a counterparty in the markets. It's like hiring a skilled navigator to ensure a safe journey. And finally, by using these strategies, businesses can reduce uncertainty about future cash flows. For instance, if a company expects to receive payment in a foreign currency, it can use a forward contract to lock in the current exchange rate. It's like securing a fixed price for selling your goods, no matter how the market fluctuates. Hedging not only reduces uncertainty about future cash flows, but also protects businesses against adverse movements in exchange rates. But hedging is not without its costs and benefits. Engaging in this risk management strategy comes with certain expenses, such as fees for entering into hedging contracts. There's also the potential opportunity cost of not benefiting from favorable exchange rate movements. Imagine if the exchange rate moves in a direction that would have been beneficial to your business, but you had already locked in a different rate through hedging. On the flip side, the benefits of hedging are compelling. It minimizes the impact of exchange rate fluctuations on international trade transactions and improves predictability in cash flows. In essence, hedging could be perceived as a form of insurance against volatile currency movements. Therefore, businesses need to carefully weigh the costs and benefits of hedging based on their risk tolerance, financial situation, and market outlook. So there you have it. That's how hedging works in trade finance to manage currency risk. It's a vital tool that helps businesses mitigate potential losses from exchange rate fluctuations. ensuring predictability in cash flows. If you found this video insightful, please subscribe to our channel for more such videos. Thanks for watching.